Mr. President of the Republic of Poland, President of the National Bank of Poland, ministers, governors, distinguished guests, ladies and gentlemen, I would like first to thank you, Mr. President, for the honor you bestowed upon me. I am extremely touched, particularly because it was for me a memory of the time when I was very close to Poland in these dramatic years before the transition, during the transition, immediately after the transition. And I have to repeat to you what I said a moment ago in private, namely that to see vibrant Poland today, for me, is extraordinarily moving, because I have the memory of Poland mid-80s. And I have to say that if something can be the symbol of this extraordinary transformation for the good in Europe and in the world, it is here that you feel it the most, I would say, eloquently. Let me thank you, dear Marek, for the organization of this conference. I will concentrate very much on Central and Eastern Europe, but I want first to echo what you said, Mr. President, a moment ago, and what Marek said also a moment ago. The euro as a currency is a great success indeed. As you said, we kept over the first 12 years, the first almost 13 years, the price stability, remarkably in line with what we had said from the very beginning with our definition, and I have to say, in a better fashion than in any big European countries during the previous 50 years. So this is a success in terms of historical comparison, as well as a success in terms of actual achievements. It's also remarkable that we have the credibility for the next 10 years when I extract from the market the inflation expectations over the next 10 years. For the second part of the next 10 years, as you said, we have a definition of price stability, less than 2, close to 2. I extract a break-even forward 5 years, for 5 years, of 1.8%. So I think this is remarkable. It's not surprising that the currency itself is credible because it's backed by remarkable fundamentals. As regards financial stability in the euro area, which is the issue at stake, I would say there you have a paradox. Euro area on a consolidated basis is in a situation where the current account is balanced and where you have a public finance deficit, which as a proportion of GDP could be, at the end of this year, all computation made around 4% of public finance deficit consolidated for the euro area as a whole, which of course in comparison with what you will observe in the other very big advanced economy is extremely flattering as a whole. And I have to say also that the rapidity of the correction of these weaknesses in the public finance is also faster than what you are observing in other major big advanced economy. The problem is that it is only true as a whole, and when you look at individual countries, you have differences, and there, of course, you have the weaknesses of the euro area that you mentioned, Mr. President, that Marek mentioned. And I would say my own reading of what we are observing since now 4 years, because we were, you might remember that it was in August 2007 that the financial turbulences started. And then we had the start of a global crisis. All what has happened since is of a global nature, including what we are observing in Europe. I would say all advanced economies are under scrutiny. All advanced economies have to correct themselves, and it is absolutely clear that there is not a single economy that would be out of this scrutiny, including the other big advanced economy. Each of us, we have our weaknesses. The weaknesses in Europe, in the euro area, are clear. It's a question of governance. Mr. President, I see that I avoided to say how happy I was to see you again. I have to thank you, Mr. President of the Parliament, for not only joining, but also for having had, for me, very kind words 2 days ago. That was very, very kind of you indeed. Thank you very much, very much. So, again, we all have to work hard, all over the world, and particularly in Europe, on our governance. And it's work in progress, as you know, so I will not elaborate too much on that. Let me only say that it is almost 20 years since the European Council met in the city of Maastricht in the Netherlands to agree on strengthening the pillars of European Union and laying the foundation for a transition to EMU. And I have to say that the changes that have been observed over the last 2 decades have been enormous, particularly, of course, in Central and Eastern Europe. The hugely ambitious path of reform, which has started there, leaving aside differences across countries, it was a long and challenging process of economic transformation, which brought countries, as I already said, in the region, significant improvements in incomes and living standards. I have to say that the changes in Europe over the past 20 years have been gigantic, equally enormous, if I may, have been the challenges along the way, and not least, of course, since the last 4 years. And I would say also that there has been incredible achievements in the process of economic convergence in Central and Eastern Europe. I would like to say just one word on the first aspect of convergence, which relates to developments in terms of nominal and real convergence between countries of Central and Eastern Europe and the euro area. Looking at the region as a whole, after very difficult first years, inflation has come down dramatically from very high level at the beginning of the transition. Long-term interest rates have fallen substantially. The countries of the region have made incredible progress in terms of institutional and structural convergence. We have witnessed the building of solid institutions. We had witnessed increased trade integration with the euro area and improvements in the business environment, which were particularly visible here in Warsaw. Naturally, this progress has been reflected in per capita income convergence over the last 20 years. Per capita income has risen to an average of 63% of the EU average, if adjusted in terms of purchasing power parity. Combining low inflation with real convergence has also posed, of course, challenges in many countries. The very process of real convergence entails necessarily upward pressures on prices, which can be hard to avoid in terms of both relative prices and the overall price level. These pressures stem from high productivity growth as well as the processes of price liberalization and tax harmonization. If I look at the price increases related to productivity growth that are usually referred to as the Balassa-Samuelson effect, I have to say that most studies have found this effect to be relatively limited. Convergence in price levels, which stood on average at 2/3 of the EU average in 2010, seems to have surpassed convergence in income levels in many countries in the region. This means that growth in prices has generally been higher than growth in productivity. The potential rigidities in labor and product markets might have complicated the delivery of low inflation rates. Indeed, I have to say that while all countries have reduced inflation to moderate levels, the entrenchment of a low inflation environment still constitutes a challenge in many economies. I would like to mention now the growth model, which is followed by some new EU member states. As people expect to be richer tomorrow than today, they may choose to smooth consumption over time by borrowing today, the more so the higher the expected gains in disposable income. A process of gradual real exchange rate appreciation, supported by strong domestically driven output growth and temporarily accompanied by relatively large current account deficit, would seem in line with what some theory would suggest. But in several countries, the process of real convergence proved itself difficultly sustainable. During the period before the global crisis, expectations were overly optimistic. Investors and consumers engaged in economic behavior that generated excess domestic demand, strong credit growth, and inflationary pressures. As in many other markets, risk premia were squeezed, leading to asset price misalignments. And I would say particularly in the housing market, as in many countries in the world. And over-indebtedness in a context of abundant global liquidity and a strong appetite for risk has been observed. Foreign direct investment flows often focused on the non-tradable sector, for example, construction, and financial sector intermediation. And we could see also in some countries foreign currency lending growing rapidly, leading to increasing balance sheet mismatches. So a number of countries in the region have experienced notable departures from price stability and wide imbalances that eroded competitiveness, and that, of course, was a problem which was accentuated by the crisis that we are experiencing. I have to say that in some countries, macroeconomic policies added to the risks. In countries with a fixed exchange rate, independent monetary policy was not available, resulting in monetary policy conditions that became too expansionary. In principle, this should have been compensated by very tight fiscal policy, but with the benefit of the hindsight, in the region, as in many other, I would say, areas in the world, fiscal policies were often insufficiently restrictive, loose, and certainly not adapted to the resilience which was necessary to stand in the crisis. These weaknesses were revealed, of course, with particular virulence by the crisis, and again, in all over the advanced economy and in the East Central and Eastern part of Europe, as well as in the Euro area, with the main and remarkable exception of Poland, I have to say. I say that in front of you, Mr. President, in front of the governor. With the exception of Poland, the region was severely hit by the crisis. Many observers feared then that if the crisis were allowed to run its course, it could really be catastrophic for the region. I'm pleased to say that this so-called potential drama was avoided, and I have to say that it is certainly something which has been remarkable, namely the way the domestic policy actions to address macroeconomic imbalances at the national level have been pursued. The precise policy action differ across countries, reflecting the different country-specific challenges and policy frameworks in place. The action, of course, generally required a strong fiscal adjustment and various measures that would be commensurate to maintain confidence in the soundness of the financial sector. The reaction of the international community has also been essential. Where funding challenges became more acute, international financial assistance led by the IMF jointly with the EU in EU member states has been crucial in supporting market confidence, and the balance of payment support facility available for EU member states has been reactivated. The World Bank, the European Bank for Reconstruction and Development, and the European Investment Banks have supported several countries. There has been also bilateral support. All this, together with the private sector represented by the foreign banks active in the region, has by and large maintained its exposure to the region, helped by the informal forum known as the Vienna Initiative, in avoiding a large-scale uncoordinated withdrawal of cross-border banking groups from Central and Eastern Europe. We have avoided a systemic crisis in the region. And of course, this remains very, very important. I have to say that from that standpoint, the ECB is making its own contribution, for example, by providing extensive liquidity provision to parent banks established in the euro area. The subsidiaries of those banks in Central and Eastern Europe have the ample liquidity which permit them to be active in Central and Eastern Europe. I have to say that it was, again, Mr. President of the Republic, an immense privilege to be invited here. I said that Poland was an exception, if I may, in this very difficult world that we are experiencing in the region. It is remarkable. I always considered, of course, that Poland was absolutely key strategically, if I may. It was true 10 years ago. It was true, particularly true 20 years ago. It is certainly also true today. We can see clearly that sound economic policies, this is a general lesson, I would say, for all of us in Europe, in the other continent, and I have to say for all countries of the world, because what I am struck when I look at the present crisis is that the reason why the emerging world has been more resilient than the advanced world is that the emerging world had known very difficult time for Latin America in the 80s and beginning of the 90s, very difficult time for Asia at the end of the 90s and beginning of the 2000s. The advanced economy had been protected from big challenges. Not surprisingly, the new crisis that we are experiencing is hitting them. Poland had experienced very difficult time 20 years ago, and it seems to me that it is one of the reasons why its resilience is clear today. But that does not call for complacency. Sound macro policies, and it is really the experience of the crisis, are the only way to preserve, enhance, maintain resilience. And that lesson will not surprise, of course, any central banker in the room, and certainly not yourself, dear Marek Balka. Thank you very much for your attention.